and welcome to the Q2 and H1FY24 earnings conference call of Computer Age Management Services Limited, hosted by Orient Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, you may signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Shivani Karwat from Orient Capital. Thank you, and over to you, ma'am.
Hi, good afternoon, everyone. Welcome to the Q2 and H1 FY24 earnings conference call for Computer Age Management Services Limited. As mentioned today from the management, we have with us Mr. Anuj Kumar, Managing Director, Mr. Ramcharan SR, CFO, and Mr. Anish Savlani, Head of Investor Relations. Before we proceed to start the call, I'd like to give a small disclaimer that this conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on date. These statements are not guarantees of future performance and involve risks and uncertainties which are difficult to predict. A detailed disclaimer has also been published in the investor presentation which was released to the stock exchanges. I hope everybody had a chance to go through the presentation. I will now hand over the call to Mr. Anuj Kumar, Managing Director. Thanks everyone, and over to you, sir.
Thank you, Shivani, and good afternoon, everyone. I thank each one of you for taking time out to join our 2Q earnings call. Like we've done in the past, we will take you through a structured presentation, and then we will have about 35 to 40 minutes for Q&A once we are done with the presentation. This has already been uploaded, so I estimate most of you have already gone through it. But just to expand on the performance of the company during the second quarter, I would say it was a great sustained story of growth in the second quarter. Like we said, we saw several historic highs. I will talk about them. Expanding business share across both mutual funds and outside of mutual funds in terms of how we got share. And then we achieved several key milestones across businesses. You would have seen that we reported, we have been sharing with you 5 mutual fund wins, 4 companies which are just starting off in the market. Now we were the 5th. Of these 4, both Helios and Zerodha went live. This was, of course, outside 2Q. This happened in October. But it's worth sharing with each one of you that both of them have formally launched in the market. So we expanded our count of active AMCs, MF-AMCs that work with us. On the overall mutual fund AUM, the first 6 months of this year and the quarter have been the best ever in recent times in terms of absolute and percentage expansion of assets. Our overall assets at the end of the quarter stood over 32 lakh crore rupees. You see a number of 32.2 trillion. This went up 20% year on year, and on a large base, that's certainly a very significant number. Overall market share continued at 68.5%. Our equity AUM crossed 15 lakh crore. End of the quarter was 15.2. This registered a 28% growth year on year, as you are aware. And our equity market share expanded by almost 120 basis points, so it's now 65.5%. A year back, this would have been 64 and some change. So that's been a sustained increase. Also in the first quarter, we've shown you our equity net sales market share, which was in the 90s in the first quarter, which obviously a 90% share of anything can look like an aberration, but very happy to share with you that it's holding out quite well. Net sales is really the net money that comes into the market from investors. We had an 80% share in the second quarter, and this is probably the reason why the equity asset market share has gone up. Outside of mutual funds, our overall, and I'm giving you a 1-year picture from second quarter last year to this year, about 3% or 300 basis points increase year in the share of non-MF revenue. This was in the range of 10%, just short of 10 1 year back in the second quarter. It's now about 13%. How did this happen? Non-MF revenue, if I take absolute numbers, grew 47% year on year. If I take out the one-time contribution of Think 360, it is still 30%, which is a very salutary number. You know that we've been talking about an overall earnings compounding of 15%, saying non-MF should be growing in the 20s or beyond that. So this was a great occurrence, 30% non-MF growth. In alternatives, which has been a sweet spot for us, we went past the 2 lakh crore or 2 trillion overall assets under management, under administration number. And then CAMS KRA, which is a product where we were focused on mutual funds till about a year and a half back. We started planning a complete revamp of the platform and from a product perspective to stay ahead of the peers, and also to make strong go-to-market efforts. I think all of that has done very well. CAMS KRA has grown almost 100% in revenue in the last 1 year, 2Q to 2Q. So that's been a great story too. So you see the financial highlights. As you know, you've read all of this. Revenue is up 13.5%. EBITDA up 15.5. EBITDA percentage at 44.5 is almost 70 points up year on year. And then profit after tax, as you know, grew 17%. So overall, just a strong story across all key metrics across businesses. Move to the next. Some of the stuff that's on the other chart, I think in summary I may have covered, but I'll just go through this. Transaction volumes you see was a historic high, crossing about 14 crore transactions in a quarter. Similarly, on the unique investor growth, we are now getting very close to 3 crore unique investors at about 2.83. Equity gross sales, again, you see about 67% share in the market. But what stays back with us, gross is always gross of redemptions. When you net it out, that's a 99% share in the last quarter, 80% in this quarter. And again, this is a great number to have on our side. Of course, we have to continue watching. This is the cumulative impact of how our AMCs and their schemes are performing in the market in terms of their relative share of sales. But I would say a great number for us to have on our side. And similarly, as you've seen, the SIP juggernaut continues to move in terms of overall SIP registrations in the market. CAMS individually is now registering anything between 60 to 65 lakh gross SIPs in a quarter. You see a number of over 30 lakh or 3 million net SIPs. This is net of redemptions, net of SIP expiry and withdrawals. So that's a great number too. We've never had a number as large as that. And riding on all of this, a live SIP share, like you can see, has grown from 56.1 in 1Q2. It's grown about 0.7%, 56.8 in the September quarter. Similar numbers when you juxtapose them with the market. I'm sure you've been watching these numbers closely, so I will not go through this individually. But I think overall equity share gain and equity net sales overall share has been a great story for us. So has been SIP collection and net SIP register. Move forward. From a transaction volume perspective, you can see almost a 24% year-on-year growth. Points to a degree of retailization when transactions are moving faster than AUM and moving faster than revenue growth. But that's a great story again, because the middle of the pyramid and going towards the bottom is really where a lot of participation will come in these markets as individual transaction sizes and commitments by investors continue to become smaller. But that's a great sign of participation. SIP book, I spoke about that, grew about 24% year on year, 8% in the quarter. You see similarly live folios grew about 18% year on year, and unique investors about 17%. Systematic transactions processed, this is the SIPs that we trigger and collect against each year, grew about 13% on a year-on-year basis. From an overall, and I'll give you a short commentary of each of these businesses. As you can see on alternatives, the story continues to be very strong and steady. We won, from a full service perspective, 15 new to CAMS logos in 2Q. WellServe, now we've introduced WellServe 2.0, so which is several notches and steps ahead in terms of digital onboarding and servicing of investors. Now we have 100 plus clients that we've been naming in the past who have now adopted a digital onboarding capability on AIF. Temenos Multifonds, which is part of the fund accounting suite, which we announced in the last quarter, is now ready to take on clients. So we expect to report this to be live and in service in about 2 months from now. We also built out and did a beta limited launch of our first analytics platform, WebTrack, which will aggregate data on the alternative side, largely on AIF, and then provide contrast just like we do in MFX or view versus industry for industry participants. But also very importantly, Fintuple, which is done, we've told you in the past, bespoke work is near conclusion of a very large transformation in one of the top private sector banks. You will see some announcement come from us in December. So this is starting from their custody operations. This basically integrates every other component of the alternatives operating arena and creates ability for them to share data, onboard investors, and just takes out all the wrinkles and creases from their operating setup. So you'll see this announcement in December, and as the platform goes through a formal launch, this is a very synergistic offering. So whether it is video KYC capabilities from both CAMS and the Think 360, and several other things, including cancel zone, RTA operations for AIF. It blends in all of that, and you will see some media press on this in December. From a FinServe perspective, I think the great number is that we are holding at about close to 10% market share. This used to be small single digit till about 2 to 3 quarters back. Our number of live FIUs continues to expand and has crossed 50. And I must say that while this was thought of mostly as lending use cases in terms of small ticket lending, largely digital lenders adopting account aggregator for creditworthiness of individuals, the other use cases are now becoming very popular. So large broking houses are using this for F&O account opening for pulling bank statements. PFM use cases are now getting bolstered. Similarly, third-party verification are use cases now live in several of the brokerages and MS, etc. So non-lending use cases are now kind of gaining prominence. Of course, this will happen over a few quarters or years, but it's a good first sign to see in the market. From a payments perspective, we've continued to expand and do well. UPI AutoPay, like we said last time, is continuing to get adopted and may become over a period of time as the preferred option for SIP payments and recurring payments for individuals. CAMS KRA, this is something that I alluded to, and you may have seen some press and a lot of information on our website, etc. So we brought out this 10-minute KYC solution where it enables almost instant onboarding from a brokerage, demat account, and MS perspective. It's become a very popular solution. And when you bring in all the components of technology that we've done, which is things like OCR and face match, liveness check, etc., which used to happen in a lagged in time kind of format, which is all now getting done quickly. The algos and the technology enables all of this. And that's what has enabled us to broaden out the offering to bring in both fintechs and brokerages. It was largely a mutual fund focused offering. We were selling largely to MS, but we've gone beyond that. So we've seen 3x increase in monthly volumes, but importantly, almost over 100% year-on-year revenue growth. This, of course, was on a small base. The base is larger, but we expect to see more growth in the coming 12 months as some of these operations stabilize. Large customers continue to opt for us, and then existing customers scale. We expect this to continue growing in the next 12 to 24 months. From a repository perspective, you will see and this is now available in both. It is available in both the Play Store and the App Store. Utility called Bima Central, which essentially allows you to open an EIA account and then start linking your policies. But over a period of time, it will allow you to do various other things, including, like we had said, making your payments as regulatory blessings are received, to do lien marking and borrowing monies against your policies, seeing a single screen with all surrender values, etc. So various augmented capabilities. Now this requires us to tie up with all the almost 50 odd insurers, both in life and non-life. The good news is that the top 5 have now been signed up for this. Also from an overall policy perspective, we are 40% up year on year in terms of EIA addition. And like we said, there is sustained interest. While the EIA was a relevant product for the life insurance sector, now the non-life insurers are showing sustained interest on this. So as we continue our journey, continue expanding the number of EIA accounts, make the journey of opening an account frictionless, linking all your policies, and then value-added services of the kind that I said, we will see a lot more interest. Of course, the prerequisite is to bring every insurer on board. That's a process that will take some time. But happy to report this is a unique product. This is not available with any of the repositories today. And we're expecting to scale on the back of these capabilities. Of course, there is no change in the overall regulatory position on insurance policies being pushed into DMAT. So that remains as an item which is under work, under progress, but has not finally been declared as mandatory. From a CRA perspective, we've continued to make inroads into the POPs and some progress in the corporate segment. We continue to retain the number 2 position in ENPS. And then from a Think 360 perspective, we've continued to sell quite well the 3 key products, and that story is going well. From an intellectual property perspective, the PFM module and account aggregator is now fully built by Think, and we have acquired several customers. Think is also introduced into the market a Geo Wealth Index, which is able to take an address and through various direct and surrogate means is able to establish the potential wealth capability of the individual who resides or rents in that phase. And similarly, we're doing some work around generative AI and finding use cases in the market to be able to sell this profitably. So that's the overall story on Think. Like I said, both from a Algo 360 and Quick ID perspective, we continue to scale and sign new relationships. So that's really it in terms of overall operating highlights and what's happened to the different businesses in terms of scale, share, volumes, etc. I will hand over to Ramcharan so that he can speak about the financials.
Thank you, Anuj. I'll just spend a couple of minutes on the broad financial numbers. And as Anuj mentioned, this was a strong quarter from a revenue as well as from a profit perspective. So revenue for the quarter was 275 crores, which was up almost 13.5% year-on-year and 5.3% quarter-on-quarter. The revenue last quarter, if you recollect, was around 261 crores, and the last year, same quarter, was 242 crores. This was on the back of a smart growth in the AUM and the mutual fund revenue. The AUM on a year-on-year basis grew more than 20%, translating into MF revenue growth of almost 10%. And on quarter-on-quarter, the AUM grew by 8.7%, translating into a MF revenue growth of 5%. So tracking this smart growth in AUM, we have been able to grow the revenue almost in line with the growth in AUM, especially on a quarter-on-quarter basis. The asset-based revenue grew 9% and 6% on year-on-year and quarter-on-quarter. We are at 202 crores almost of asset-based revenue. The non-asset-based revenue grew 13.6% year-on-year. We have seen some uptick coming in the applications that we run, including MF Central and various other applications and platforms that we license to the mutual funds. So that's seen a good momentum and continuing momentum on the revenue, and there has been some increase in the call center too on both year and quarter, translating into a smart growth on a year-on-year basis of 13.6% on the non-asset-based revenue. Currently, the non-asset-based revenue per quarter is around 38 crores. Non-MF revenue, Anuj touched upon this. We have seen a good growth in a non-MF revenue, almost 47% on a year-on-year basis, equalizing for Think Analytics acquisition, which was not in the base. Even then, it's at 30%. So we have seen, what we have estimated is a little ahead of what we estimate in terms of the non-MF revenue growth, and that's translating into the percentage of non-MF revenue being close to 13% for the quarter. Even on a quarter-on-quarter basis, we saw an uptick of 7.4% on the non-MF revenue. So the non-MF revenue is currently around 35.5 crores of the overall revenue. So we're continuing to see positive trends on this, especially on the KRA business. We are seeing stable to growth revenue from an AAF perspective. Payments is continuing to do well in terms of the ramp up that they are seeing in the number of transactions. So all in all, we are on track to meet our targets in terms of increasing the pie of non-MF revenue. The asset mix you will note for the quarter is actually very favorable. The equity component, which used to be around 45% last year, is around 47.7%, and hence it's translating to some benefit for us in terms of yield. On the yield commentary, I think in the last couple of quarters or more than that, we had indicated that there is a large contract that is being renegotiated after 5 years, and we had indicated some impact of that will be felt. And during the last earnings call, we had clearly stated that there will be some spillover impact in the current quarter, post which we believe that it will be business as usual. Happy to say that that's been the actual case, and we have concluded the contract, and we are seeing some spillover impact of a marginal decline in yield in the current quarter. But going forward, our estimate is that we will not see any unusual yield movements, and it will be restricted to the impact of the telescopic pricing, at least for the foreseeable future or the next few quarters. So that's the commentary on the yield. Hence, you will see a small depletion in the yield, but we feel that the impact of all the renegotiations has already been considered, and we do not see any big impact going forward on the yields, other than the telescopic impact. On the profit perspective, backed by the growth in revenue as well as some operating leverage, productivity and automation and some cost control measures, you will see that we have ended the quarter with a 44.5% EBITDA, which is equal to or better than the margins that we saw in the earlier many quarters, right? So we ended the quarter with an operating EBITDA of 122.5 crores as opposed to 110 crores and a 42.2% in Q1 of FY24. And last year we had 106 crores or 43.8% EBITDA. So we are seeing an uptick in the margin as well as the absolute number in terms of the operating EBITDA. This is translating into a margin growth even from PBT and a PAT perspective. And for the quarter, PAT percentage was close to 30%, 29.7%, with a PAT of 84.5 crores. Again, trending upwards in terms of the margin percentages, reflective of our cost control as well as the operating leverage that we feel is flowing into the bottom line in spite of small depletion yields that we are seeing in the top line. Our return on net worth continued to be impressive at more than 42%, and we ended the quarter, 30th September, we had a cash and cash equivalent of 528 crores. This was after payment of dividend of 98 crores during the last quarter, and the board was pleased to declare an interim dividend of rupees 10 per share in their meeting yesterday, for which the record date is announced on the 17th. So this, when you see the trend going forward also, when you see the trend in the later part of the presentation, you will see that the margin trend as well as the revenue and the PBT percentage absolute numbers seem to be trending upwards, which is reiterating the commentary that Anuj and me have given in terms of this being a strong quarter and looking forward to maintaining and a minor improvement in margins going forward, as we think we have seen the worst all days over in terms of the yield compression over the last few quarters. So this is the commentary I had on the revenue and profit numbers. I'll hand it back to the moderator, and they can open it up for questions.
Thank you so much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants who wish to join the question queue may please press star and 1 now. The first question is from the line of Mr. Santosh Keshri from Keshri Finance. Please go ahead.
Am I audible?
Yes, you are.
Okay. So, congratulations on a good set of numbers. I just had one question, very important question in that. When you say telescopic impact of the revenue negotiation is over.
Mr. Keshri, is it possible for you to use your handset while asking a question, please?
Oh, sure. Am I audible better now?
Yes, sir.
Yes.
So I had just one question. When you say that telescopic impact of the revenue negotiation is over, what exactly you mean by that? I do not understand the term telescopic.
Yeah, sure. So let me just try and explain that. The pricing structure that we have with our mutual fund customers is actually scale-based, which is that there is no single BIPS rate that we charge for the assets under management. So we broadly divide this, and while the rates may be different for different customers, the structure is broadly the same for all the customers. There are asset class-based BIPS that we agree upon. For example, equity, debt, liquid, and others on ETFs, passives, etc. So, for example, take the equity, the rate of BIPS that we arrive at for a particular customer is not the same. And as the AUM keeps growing, for example, if you had a 5,000 crore AUM of equity, assuming that your BIPS was, say, 7 BIPS, if you get to the next 500 crores, the rate will fall from 7 to 6.5 BIPS. So as you grow in AUM, the marginal billing that we do or the marginal cost for the mutual fund customer keeps decreasing. This is a deliberate inbuilt structure that is there in the pricing agreements with our customers to ensure that the benefits of scale gets passed on to the customers without them having to come back to us every time that there is a big growth in assets. So typically what we see is as the assets keep growing for the mutual fund customers, if your asset growth is say 10, then my asset fee growth is generally between 6 and 7, which is that we have a 30% depletion that generally happens, sometimes 25, sometimes 30 that happens between the growth that you see in the assets versus the growth you see in the asset fee, which is what is called a telescopic pricing structure.
Okay, so sorry, then what exactly is meaning of telescopic impact? The grade-wise increase or decrease is not going to happen anymore?
No, sorry. What I said was barring the telescopic pricing impact, because the rates generally go down because of telescopic pricing, because of any large renegotiation that happens on the base rates itself with the customers. We had indicated during the last few quarters that a large customer's contract for the last 5 years was renewed just now with a decrease in rates. What we indicated was the impact of that will not be felt further. The only impact you will feel will be the impact of the telescopic pricing.
Okay, understood. Thank you so much. That was my only question.
Thank you so much. Participants who wish to join the question queue may please press star and 1 now. The next question is from the line of Mr. Sanal Desai from ICICI Securities. Please go ahead. Mr. Desai, your line is unmuted. Please proceed with your question. Mr. Desai, could you please unmute your line? As there is no response from the line of the current participant.
Hello, am I audible now?
Yes, sir, you're audible now.
Yeah, sorry for the technical problem. My question was related with the yield movement. As you said that there was some effect of the yield reset in this quarter. In a way, going ahead, also in this quarter, we also saw a big AUM jump. So part of the impact would also be because of telescopic and part of it would be because of the yield reset. Any color which you can share on the extent of decline that we have seen in this quarter because of the yield reset, which will give us a better idea about what to take the yield assumptions for the coming quarters and also the year ahead.
The way to think about this is you saw 20% AUM expansion 2Q to 2Q last year to this year. Normally, you would have seen about a 14 to 15% revenue growth. What you saw is about a 10% revenue growth. The 15 minus 10 is perhaps a broad equivalent of what you're asking for, right? If we did not have that one-time adjustment, then we would have delivered the 14 to 15% on the overall asset growth, which was only 10%. The 15 minus 10 is then approximately the impact of whatever we're talking about.
Understood. So going ahead, it will fall back to our historical way of decline, which is in line with the telescopic thing, right?
That's correct. So if assets, let's say in the next 12 months, grow 20%, there's no reason that revenue will grow only 10%. Revenue should grow 14 to 15%.
Sure. That's really helpful. Thanks a lot. I'll get back in the queue.
No problem.
Thank you so much. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, sir. Good morning. Hope I'm audible.
Yes, you are.
Yeah. So just a few questions. First, if I look at your non-asset-based mutual fund revenue, this quarter, on a quarter-on-quarter, it seems to be on a flattish side. Given that there are a lot of activities going on in the mutual fund space in terms of be it NFOs or the market being buoyant, so I would have expected that mutual funds would be spending a little bit more on this front. If you can give some color on that, that's question number 1. Question number 2 is on your non-MF revenues. If I strip up the KRA business and look at the other businesses from a momentum perspective sequentially, like if you look at Think 360, over there, it has been relatively flattish or down on a QOQ. So the other businesses have also been not that great in terms of momentum of take on the revenue side compared to, let's say, the client wins or logo wins or business expansion side. So just wanted to get some color on that. Lastly, in terms of expenses, can you give some color on incremental costs that you need to incur on the new businesses and what sort of EBITDA trajectory should we want to see on that?
So thanks, Dipanjan. I'll take the question on the non-asset-based revenue as well as the expenses, and I will request Anush to come in on the non-MF business. See, on the non-asset-based revenue, you know that there are 5 components major of it. It is the transaction-based, the miscellaneous application-based, the call center, the NFOs that we build for, and the out-of-pocket expenses. What we have seen as a trend is in the last quarter, we have not seen any big increase in the transaction base as such from a paper transactions perspective. What we have seen is some moderate increase has happened from a call center and from a miscellaneous application perspective. While year on year we do see a good increase, in terms of revenue, quarter on quarter it has been flattish. What we expected, and again, as I was earlier mentioning, we do not expect the non-asset-based revenue to kind of propel any growth for us or to propel any profit for us. Because basically the transactions being up or down does not incrementally impact the profits. So we would assume that they will be static within the same levels that we are seeing now. The only upside that we could see is some increase because of the MF Central related revenue that is there in the application base. That's the only increase that we could probably see to be profitable growth in the entire bucket that we see there. OPU, because of some reasons in terms of regulatory issues and all those things, should go up and come down by a crore here and crore there, but all those things are compensated by increase or decrease in revenue. So that's the reason for the non-asset based revenue remaining static on a quarter-on-quarter basis. From an expenses perspective, I think the major expense increase that you will see will be the salary expenses. Even on a year-on-year basis, my entire salary head has increased by 7.6 crores. And that includes the salary impact that we have given in April, which is more than 6 crores. So we have been remarkably disciplined in terms of adding manpower or regulating the cost from a manpower perspective. It includes the ESOP cost increase, it includes the Think Analytics cost. Everything put together on a year-on-year basis, we have increased cost in a salary only to the extent of 7.6 crores. So we feel that going forward, there will be stable cost that you will see. In fact, on a quarter-on-quarter basis, if you see the increase in revenue is almost like 13 crores and the increase in EBITDA is 12 crores. So while that could not be replicated every quarter going forward, we feel that the incremental cost will be measured. And we generally expect 50 to 60% of the increase in revenue to flow down as the EBITDA in a normal quarter. So from a fixed cost perspective or from an operating expenses perspective, operating expenses generally remain at around 7 to 7.5% of revenue. Definitely less than 8. That's what they will continue to remain if you remove the OPE part of it. With OPE, they'll be around 12%. The trend has been remarkably stable across the last many quarters that we have seen. The employee expenses, as I said, since we're able to control, we're in fact seeing a downward trend. It's a little more than 34% of overall revenue. And the fixed expenses, even on a quarter-on-quarter basis, you have seen this decreasing. And a couple of quarters back, there was a concern raised regarding why have your fixed expenses gone up. And I understand we set expectations saying that you will see this is the peak and you will not see a lot of increase other than inflation-driven increase going forward. I think that's what it's played out in the last couple of quarters too. I will kind of wait for any questions from you on this, or Anuj can probably take the question on the non-MF.
So on the non-MF revenue, while we've stated that overall year-on-year growth is 47%, netted for the one-time Think Analytics revenue, which started accruing in the first quarter, that's about 30%. You're right, in this quarter, KRA has really driven a lot of this growth. Now, last quarter also, KRA driven growth. This has been a substantial quarter from a CAMS KRA contribution perspective. However, from our overall, sales focus and signings pipeline, etc., we are very sure that the others, which is CAMS Pay, Think 360, AIF, and insurance, will be large contributors in the coming 2 quarters. But in this quarter, you're correct, the large part of non-MF increase outside of Think has been driven by CAMS KRA.
Sure. So just if I can ask 2 more follow-up questions. One on your AIF side. On the incremental sign-ups, your competitor highlighted that they have moved from a flat fee-based slab to more of a AUM-linked slab, like you see in mutual funds. I just wanted to get some color on whether you have also made some changes on that part. Second, more of a structural question. Well, let's say in this quarter, for example, mutual funds or last 2 quarters, mutual funds have seen very sharp growth in AUM, and some of them have seen change in slabs for themselves on the gross TER side. Your contracts, are more from a 2-3 year perspective. So when they say change in slab, is it like a direct translation that you have built in the contract, or how does it happen, or do you expect renegotiations to be much more frequent in this sort of a market trajectory, let's say, sustains hypothetically?
Yeah, sure. So when you take the first part on whether AIFs are moving from flat pricing to a BIPS pricing, we are not seeing that. We are not seeing that, and you must, I'm sure you appreciate that the market, if I juxtapose what it was 2 years back to what it is now, is a lot more competitive. There are a couple of global players who are competing. The domestic, both us and a key competitor. So also up the ante. So in those kind of competitive scenarios, not easy to change a pricing paradigm. The current pricing model works well for us, so it is continuing the way it is. No large changes. We are not reporting any large changes. On the mutual fund side, just think of these as 2 separate trains. And how do those two separate trains move? Mutual funds, when they grow, they will charge as per the TER slab. The TER slab can continue falling from, you know the numbers, right, from about 2.25% all the way down to, let's say, 1 and some change. So that is something that the mutual fund experiences. What we experience is our pricing contract with them, which is saying that the telescopic impact, I'm just throwing a number, may not be very accurate, let's say the telescopic impact is 2%. So we will see our contraction irrespective of what change in fees they are undergoing. Are they using the argument of their change in slab and their change in fee to negotiate something with us? The answer is no. While they are saying, I'm sure there are many schemes which have crossed over to higher and higher slabs, it's also a fact that our telescopic methodology keeps rates at very, very affordable levels, but it's not a one-to-one mapping between what they experience and what we experience.
Got it, sir. And if I can, sorry, one small question on the account aggregator side, have rates stabilized in terms of pricing, or how is the pricing pressure out there? That was all. Thank you.
Yeah, they have stabilized. The rates are maybe 20-25% of where we had started, right? So they have stabilized to a certain level. Competition, of course, in both AA and TSP is intense, but yeah, we are seeing some stabilization of rates now.
Sure. Thank you, sir, and all the best.
Thank you. Thank you.
Thank you. The next question is from the line of Mr. Lalit Deo from Equirius Securities. Please go ahead.
Yeah, hi, sir. Good afternoon. So I have a couple of questions. So firstly, on the AIF revenue, so like if we see the total AUM, so like where we are seeing a start.
Could you please use and not the speakerphone? If using the speakerphone, please.
Hello, is this better?
Yes, sir.
Yeah. So coming on the AIF revenue piece, so like if you see the overall AUM growth in the AIF segment, so that has grown materially during this quarter, but since the revenues have not grown, have remained broadly flattish on a sequential basis. So do we expect that from this growth in the AUM, the revenues could come up in the coming quarters? That was the first question. And second, like you mentioned, like that because of the renegotiation happening, there was some kind of pressure on the revenue yields. So what is the pipeline over the next 12 to 18 months? Like, is there any major contract negotiation going to take place with our mutual fund clients?
Correct. So from an AIF perspective, we've seen a steady pipeline of signings. And therefore, yes, we are expecting that the growth numbers that we've been reporting in the past should be back in the coming 2 quarters. We are quite confident of that. The AUM does continue to grow. Every pricing is not AUM linked. A lot of it is activity linked pricing. But that notwithstanding, we are seeing significant growth coming back in the next 2 quarters. From a MF perspective, you can see that we had stated that there was a large contract where we were resetting prices because of some historical context. That exercise is now over in the second quarter. There is nothing major which we believe, and that was like a once in a 10-year event, and you've seen that we saw price depletion in a sustained manner for about 4 to 5 quarters. In the next 4 to 5 quarters, we did not see any event like that happening again. So, like Ramcharan said, you can expect a marginal, small, telescopic rate-led depletion, but nothing major from a price negotiation perspective.
Sure. And so just last one data question, like you mentioned, clarification, like you mentioned that the fixed expenses will be 12% of our revenues, will be below 12% of the revenues. Or was it something else?
Sorry, can you just repeat your question, please? Sorry.
So the other fixed expenses, like as you mentioned that the operating expenses will be like below 8%, below 8% of the revenues, and then there was some 12% of the revenues. So I just missed that part.
I think what we mentioned was operating expenses. If you take the out-of-pocket expenses, right, which is included in the operating expenses as well as in the revenue. If you just do a division of the two, it comes to 12%. But if you remove the out-of-pocket expenses from the numerator and denominator, just from the sales as well as the expenses, the real operating expenses that they incur, which is mainly some data entry cost, the sponsored bank charges that they do for the payments businesses, and some things like that, the amount will be less than 8%. It is generally between 7.5 to 8%. That was what I was mentioned on this 12% and 7%.
Sure, sir. Yeah. Thanks for the answer. Thank you.
Thank you. The next question is from the line of Mr. Abhijit Sakhare from Kotak Securities. Please go ahead.
Yeah, hi, good morning. I joined the bit, so some of it could be repetitive. Sorry for that. The first question is that on the non-MF side, there is little bit of volatility on the insurance. If you could explain that first. And secondly, let's say on a 12-month basis, is there like a visibility on could be the growth all of these businesses put together? I think we are delivering somewhere close to about 20-25%. So does that run rate still hold when you look forward 1 to 2 years? Second question is that when we look at the overall EBIT margins at around 40%, is it possible to kind of break it down, how the RTA business is doing and the rest of the business is doing? And the related one is that are we largely done on the investment front on the non-MF businesses? So from here on, the translation of revenue growth to bottom line, as Ram sir mentioned earlier, that should kind of continue as well.
For sure. So on the insurance side, while we've been reporting growth in EIA accounts and policies, you are aware that there's a large fraction of the revenue which still comes from outsourcing services. In our persistency operations, there was some fall off from last year to this year, which is why you've seen a small diminution in the overall insurance revenue. From a non-MF perspective, we've stated that we would like to grow 20% in revenue terms. And right now, for the next 12 to 24 months, we'll be just holding that number. We expect to grow 20% plus in the overall non-MF portfolio for the next 1 to 2 years. So we're holding that number. On the third part of the
EBIT on the... So, Abhijit, on the EBIT part of it, the as a bucket, the non-MF, if you kind of combine the non-MF versus MF, I think that was your question in terms of what will be the split between the two. See, your MF EBIT is obviously on the higher side. It is much higher than the 40%, 44% EBITDA that you're saying there. But having said that, I think if you look at the single bucket, non-MF might be less, but within that, AAF is also equally profitable, and CAMSPay is reasonably profitable. So non-MF, MF, yes, MF was higher EBIT than the remaining things. But within non-MF, there is a pocket like AAF or a payments which continues to be very profitable. So that's basically the numbers how they pan out.
And also,
it's actually very profitable.
Yeah.
KRA is a platform-based business, so that profitability is really high. So that's how it breaks out.
And that 20% growth rate on the revenue front for non-MF, does that deliver even better growth rate on the EBIT or EBITDA front?
It will for sure, because as we said, from an insurance perspective or from a payments, the platform is ready, and we would the incremental policies that come on board and the Bima Settle, if it goes when it goes live this quarter and start getting some traction from a revenue perspective, we feel that it will be accretive to the EBITDA, and hence as a business, I think both insurance and the payments business could see some uptick in margins. Insurance definitely, payments maybe.
Got it. And last one, the core RTA business, from a OPEX front, there is nothing like a lumpy expense in the pipeline, right? Like all the cloud tech related expenses, regulations, all of that is behind us, right?
So yes, that's right. From OpEx perspective, we do not see a big lumpy expense that needs to be done from our side. However, if there is a big project that we are doing from a technology perspective, we would probably have to think about it, and that will be more long term. So on the immediate few quarters from OpEx perspective, we do not see any lumpy expenses that are going to come to you. Although regulations do continue to come. In fact, even from a KRA perspective, there have been regulations on segregation of infrastructure and movement to cloud, etc. But we are confident of keeping those things under check, and you will not see a big lumpy expenses that's coming in.
Okay, got it. Thanks a lot.
Thank you so much. The next question is from the line of Mr. Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. Good afternoon, everyone. Firstly, on the core business of, we've seen a lot of SIP addition coming in from the fintech platform, and the transactions that we are doing are coming in from fintechs more than earlier, where we used to do a lot of paper-based transactions. So do you think does that incrementally contribute in any form to the revenues apart from the AUM that they add, or how much of our revenues would we kind of have some linkages to the number of transactions as well? Any clarity there?
So first, think of it this way that that train has been moving for many years now. Think of it as having been moving for the last 5 years. We have single AMCs whose paper transactions are in single digits, which means that digital and electronic is 90, 91, 92, 93. That kind. Our gross portfolio level paper is 12, so 88% is non-paper. Paper, like we've said, is revenue accretive but not margin accretive. It also creates risk because once we digitize the paper, then everything else remains identical in our system. The process of digitization takes effort, cost, and introduces a form of risk. So we are very happy with the way things are. Also, do remember that the fintechs have brought unprecedented scale to this market. The scale was not available to the market in the traditional distribution paradigm. The fintechs have brought scale and have brought packet sizes which are much smaller. So overall, if you see, we do book revenue from paper transactions, which is not a very large number. And even if it is drying up, and it is drying up for the last, as long as I can think, last 7-8 years, every successive quarter it would have dried up. But the scale, the efficiency that it brings into the system is accretive to us and takes out a lot of labor and a lot of risk. So that's a positive movement for us. The revenue fall-off is a very small sacrifice to make.
Got it. So I actually wanted to understand the relationship.
Your voice seems to be breaking.
Hello, can you hear me?
Yeah, this is much better.
Yeah. So what I'm saying is, 100 rupees SIP will still fetch you a 3.5 basis point yield, and same, say, 1 lakh rupees SIP by an HNI would fetch you the same yield. Is that a fair way to look at it, or is there some, or from a cost angle, both would require same amount of efforts or from your side, or is that the right way to think?
Yeah, absolutely. That is the right way to think. That from an AUM perspective, the 100 rupees SIP will be much smaller. It will take a long time to create a mass. An HNI's 1 lakh rupees SIP will be very different in character because it will create AUM much faster. But think of the 100 rupee SIP to be coming in millions, while the HNI SIPs will be a few hundred or a few thousands. So when you see the scale, we have crossed now 10,000 crore of net monthly SIP collection at just CAMS level. During the COVID phase, this number used to be 4. So in less than 3 years, we are almost 2.5x. That kind of scale has been built on distribution and built on this creation of small sachets. It's not built on HNI's participation in this market, as you can see. So that's really the right thing for the market. It's going in the right direction.
The only thing I'll add to your question is, Prayesh, is that the process of this SIP collection trigger is largely automated. So if your question is whether you incur the same cost, is the incremental cost that you will incur, and hence 100 rupees is not very beneficial to you, I think think the process is largely automated, and hence that should not play a big part in this.
Got that. Okay. The other part was on the account aggregator piece. We're hearing that the PSU banks are still finding it challenging or apprehensive about coming on board for the on the account aggregator platform. And so, what's your sense there? And earlier, whenever we used to interact, you said that FY24 we'll have much more clarity about when this account aggregator will start contributing to our revenue stream. So any thoughts on these two aspects of the account aggregator business?
So from a participation perspective, every PSU bank is on board, each one of them. In fact, most of the private sector banks are on board. The smaller regional rural banks are coming on board. What you're observing, but you're partially correct, what you're observing with public sector banks is that they may not have built the capacity or the finesse and technology for data transmission to be 100%. So if we send 100 requests, will all 100 get answered? The answer is no. Typically in an exchange like this, 60 to 70 should get answered. If you're answering only 10 or 20, then there is something wrong which needs to be fixed. So there are small incidents of that kind, but from a signing and formal participation perspective, all of them are there. I think we are seeing signs of revenue, and that revenue will be, this year would be maybe a few crore rupees, right? So it could be a 2, 3, 4 crore rupee number as we progress. But it's a good number to have because it's the beginning of the revenue stream. We are pushing through transactions, we have integration charges and sign-up charges, so all of that is happening. Of course, like we told you, that price depletion has been almost 80%. What used to sell for 10 rupees is selling for 1.5 and 2 rupees. So revenue has contracted to that extent. It still remains a very exciting market. I think the good thing to focus on is how many use cases are emerging, for how many physical, actual labor-intensive processes can you find a substitute through account aggregator. Like I said, whether it is small ticket digital lending, whether it is account verification, part of the KYC process, NFO onboarding, third-party verification of bank accounts, there are multiple users. So if you keep your eyes on that, you will find that slowly the manual process will get phased out from the country, and these revenue scales will be much larger than what I'm talking about right now.
Interesting. And last bit on the EBIT margins, you mentioned that there are the non-MF businesses are at lower margins as compared to the MF businesses, but some of them are doing reasonably good margins. But any of these businesses that can scale up to the levels of the MF business margins, say in the next 2 or 3 years, any thoughts there?
Sorry, so I will just give you one example that wherever we have achieved a platform capability, which means I have hundreds of small users plugging into a platform, I don't have to deploy too much labor or new development. All I need to deploy is storage, servers, connectivity, ability to manage APIs. Businesses start delivering 40% EBITDA. A great example is our KRA business, which is delivering that margin as of today after the recent scale up. Our AIF business is very close to that margin. So they are very close to the MF margins. Payments has undergone some pricing pressures, etc. recently, so maybe a little lower. But as payments grows, let's say another 30-40% in size, it will start mirroring these numbers. So the good thing about the business, and so will insurance repository be. So, I mean, you can think that as a business, I don't have to scale it to 100 crore. As I scale a business to, let's say, 25 crore of revenue, 20 to 25 crore, it is possible for that business to be at 40% margin. And we are seeing that in MF, we are seeing that in KRA, we are seeing that in AIF. And the ones to watch out for are, let's say, payments and insurance, where you'll start seeing similar character maybe 3 or 4 quarters from now.
Sure, that's very helpful. Thank you so much.
Thank you. The next question is from the line of Mr. Jeet Suchak from Nuvama Wealth Management. Please go ahead.
Hi, management. Thank you for taking my call. Am I audible?
Yes, you are.
Okay. So for mutual fund business, transaction volume grew year-over-year 24% and QOQ 10%. So how is it contributing to revenue or cost? If you can give me an idea about that.
Most of this was digital volume. most of it is digital volume. If you see, we do about 60 crore transactions in a year, 55 to 60 crore. Over 80% of this is SIP triggers, and that's a completely digital process from the time we collect all the information about the SIPs being live, to do a KYC check of them, to placing them with the sponsor bank, NPCI, etc., to collect the payment, to creating the units. It's completely untouched by hand. So there is no real cost implication there. I used to trigger, let's say, 2 crore SIPs a few years back. I'm triggering 4 crore. I could also trigger 8 crore. But the quality of processing that we've built and automation is not really cost accretive. From time to time, we will add server capacity and storage, etc. But there's really no labor in this, which is managing anything.
Okay, and any increment in revenue for the transaction volume?
So generally, most of the digital transactions, triggers, SIPs, etc., do not result in any incremental revenue also. It's only the paper transactions that generally are giving us revenue in terms of per paper transaction being processed. So these could not have a large impact on revenue and cost.
Okay, that's my question. Thank you for answering.
Thank you so much. That was our last question. I would now like to hand the conference over to Mr. Ram Charan, CFO, for closing comments.
Thanks, Sagar, and thank you to all the participants for your participation in the call and the continued interest you are showing in CAMS. Please feel free to reach out to either Orient Capital or Sri Anish Savlani, Investor Relations, for any questions that you may have, and Anuj and me are also reachable in case you have need any clarifications. So once again, thank you for being part of this call.
Thank you. On behalf of Computer Age Management Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.